Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, June 7th, 2018. I wanted to do a quick market update, follow up to yesterday's post with these 60-minute wedges, see where we're at on those, and take a look at a couple other things. We'll keep this one pretty short. This was yesterday's post on the S&P 500 Futures 60-minute chart, showing this rising wedge, and we had just made a tag at the bottom of that wedge, which I believe would be the last, and I still do believe will be the last reaction. And I say that because you can look where the wedge is. Now you can take these uppermost trend lines. The uppermost trend lines, of course, are just divergence lines. So those can be extended, moved up, as long as the divergences are intact. Now what's most important, whether you have divergences or not, are the uptrend lines. That's support. This isn't support or resistance or anything really of that nature. It's just, again, a simple divergence line. So that was yesterday. Let's see where we're at today. We have moved down. There was that last tag, and I said we might make a marginal new high up, which we did. And so far today, a nice big bearish engulfing candle. You see these little candles. These are dangerous when you have this low volatility ramp and the market just refuses to go down, and everybody thinks it's going to go up forever, and then it takes boom, one big red candle like this has now wiped out. Again, we're talking a 60-minute chart here. So we can't take too much of it yet, and most importantly, we're still above trend. So I'm not, this is not anything to get excited about. However, it's pretty bearish because it does engulf. In other words, it wipes out the last, I don't know what, easily over a dozen candles to about this point right there. In other words, I'm talking about the body of this candle, where it is right now, where we're at the lows today. We wiped out all the way back to this candle here. So let's see what happens. And again, like I always say, support is support until and unless broken. But the divergences and everything else indicates that support level will likely go soon. But now let's forward. Let's move forward to the Nasdaq futures here. Let's go down. Messed that one up. Let's scroll here. This is yesterday's. This was the same chart, I should say, in yesterday's post. The NDX futures, Nasdaq 100 futures, and I had we were back testing this minor trend line here. We have this minor price channel right here, and this is the important trend line. This is the uptrend line to watch. So I had a scenario whether we'd get another thrust up or not, a move down to this trend line right here, get a reaction, and then go on to break that one. And this, by the way, is what it's all about. I don't want to spend a lot of time on the S&P 500 because it is all about the Nasdaq. It has been for a while. It definitely has been on this rally. It's really the FAANG stocks, the big market, big heavy tech stocks that have been leading this market up. The Nasdaq 100, especially the FANGs, have vastly outperformed the S&P 500 year to date and on this most recent rally. So that's what I'm watching. That's where my focus is. Again, that was a scenario. Let's see where we're at today. Jump over to the Nasdaq 100 futures, and there it is. We had that little breakdown. We pushed up, made a marginal new high, kept the divergences still very much intact. And again, this is I would put a much higher weighting on this chart than I do the S&P 500, even though the S&P 500 is the broad market. Let me move this down. Might have been cutting off part of the screen there. There you go. So there it is. We hit that level. We've had a reaction so far. You can see that we're holding on it. That's a reaction. We fell quickly down to it, wiped out a lot of candles. We wiped out several days of trading, and you go down to let's see. It's a long-term chart. You can go to a 5-minute chart. You can see here's the reaction. This is what I'm talking about. You can see these 5-minute candles. So for about the past half hour or so since we hit that level, we've been holding on it. And I define a reaction as a bounce and or a consolidation. So far, this is a consolidation. And again, these divergences indicate we'll take that out, and there's my target. Roughly 70-10, give or take on the Nasdaq futures, and we'll see. We'll go from there, and I'll try to give you some targets on the QQQ as well. I know a lot of you guys trade the Qs, and I've had requests. I cover the futures quite a bit because it paints a different picture. Since it's virtually round-the-clock trading, you can pick up on divergences and a lot of support levels and resistance levels that don't show up as clearly on the Nasdaq 100. I'm sorry, on the tracking ETF QQQ or the index itself. Before I roll into QQQ, let me just share something I posted in the trading room today in response to member Francis Q, who's posted some great analysis. Thank you very much. A lot of analysis, and there was a recent post this morning on the VIX and the SPY, and I've been watching lately the Nasdaq Volatility Index, the VXN. Everybody talks about the VIX, but again, this rally has been about tech and the Nasdaq, much more so than the S&P 500, and so therefore that's where my focus is, on the Nasdaq Volatility Index, the VXN. And you can see, this is a chart I posted showing a divergent low back here that led to this big spike in the VIX. And obviously, when you see a big rally in the VIX, that means the market's correcting. Divergent low back here in December. And you can see, and this is something else that you'll notice, that usually you see volatility tick up. I'm going to show you another chart here in a second before the market actually, before a correction sets in. But either way, it was priced in. We had a divergent low. You can see the VIX starting, the VXN, I should say, starting to ramp up, and then it really shot up once we had that correction in late January into early February. And then again, we had another leg down. So right now we have another divergent low. You can see positive divergence down here. This little falling wedge type pattern. There's a downtrend line, and this is where I think we're, it's resistance. So if we pop in the VIX, when it does move, it moves quick. So we probably already, that's actually a chart I posted this morning, VXN. Pull up on another screen. Yeah, we already popped above that level there. That trend line. We're just starting to crack above it. We haven't really taken it out with conviction yet, but maybe I'll get to that chart in a minute here. Let me show you one more chart that I had. Okay, I followed up on that same post in the trading room with this one. This is the VXN, a long-term chart. This is a 20-year chart, a weekly chart. So you have the Nasdaq composite up here on top. You have the VXN on bottom. And to me, this is pretty simple stuff. There's nothing guaranteed in trading, but you have to look at past patterns, what's happened in the past, to try to predict what's going to happen in the future. That's what technical analysis is all about. And what stands out to me, and I've noticed this before, leading up to market tops. So these dotted blue lines are the major market tops in the past 2 decades. We have the dot-com bubble topped in March of 2000, late March of 2000. We have the Great Recession. It doesn't look like much because this is not log scaling here on top. But this was that vicious bear market where the S&P dropped over 50%, and I'm using the Nasdaq up here, which again 50% plus drop from October. I'm going from memory here, October of 2007 down into March 2009. So there's the correction. They called it the Great Recession, or Yes, the Great Recession, one of the biggest bear markets we've ever had. Again, doesn't look like much. And then we had this one here, this little hiccup back in 2015, which by some metrics was a bear market. We had some indexes, small caps, and some others that dropped, especially intraday highs to lows, over 20%. So there's some debate out there whether that was a bear market within a bull market. Either way, it was the largest correction by far that we've had during this entire bull market. So call it a bear market, call it a major correction, call it what you want. But here's the point I'm trying to make. As you can see, during a healthy advance, during a bull trend, when stock prices are rising, you have the VIX falling. However, leading up to, I probably drew that arrow a little wrong there. You can see down below, I think you've probably already picked up on this. At the final stages of a bull market or a strong advance, you see stock prices advance, and you see something odd happen. You also see the VIX, the VXN, I should say, continue to advance as well. And that's what we saw here. I did something funky here. Let me try to fix that. Okay, there it is. All right, sorry for that. So there it is. So basically, you see, when the market bottoms during a healthy bull market, volatility is falling as it should. Bull market, volatility falling. You see the arrows down there. However, there's that, usually, and it can span a year or so, a year or more, you start to see something change. All of a sudden, the base level, or the lows, the trend, if you will, you start to make a series of higher lows in the volatility index, as you did here You did it here leading up to that top. You did it here leading up to the 2000 dot-com bubble top. And we're doing that now. You notice how the VIX, despite this new highs, we have new highs in the Nasdaq composite, yet we're well off the lows in the VXN. Why is that? Why isn't the VIX falling? And it shows you, my guess is institutions, smart money are hedging up. We'll see what happens. We'll see how it plays out. We don't have any signs, not even the remote signs of a market top yet. Trends are still bullish, but this is something concerning that says maybe the writing's on the wall. And if you look at really the scope of these moves, it's about in line with these other ones. You know, it can go on for a little over a year, maybe 2 years of rising volatility. I don't know, we're about a year and a half or so into this one now. Anyways, food for thought, guys. Okay, let's just jump over the charts real quick. There's that VXN. This is updated now. You can see we are cracking above that trend line. However, we had a crack above it there. It's not a super well-defined trend line, but something to note. That's a pretty decent move so far in the VXN. Again, the Nasdaq Volatility Index. VIX, to me it doesn't even matter because again, this is about the Nasdaq-100. But these markets will move somewhat together, and so I can certainly see there's some divergence. I can draw it out. We're also at support. See this green line? That's a green line for a reason. There's a lot of reactions around this level. This was a former baseline support level for the VIX, and then we ushered in a new era, record low, unprecedented low volatility from this period here that led up to this, what some still consider and very well may prove to be a blow off top, the end of the bull market. The S&P 500 is the stock market. I'm focused on the Nasdaq 100 now because it holds those top components that even they're top weighted components within the S&P as well. But the S&P 500 is still very much well off its highs, as we know. You can see there's the high back in January. So let's see what happens there. Let's just look at the charts on Qs and we'll wrap it up here. There's QQQ. Pretty nasty bearish engulfing candle. Like looks right about yesterday's high. So far we're engulfing the previous candle right now. So we have a potential bearish engulfing candle. What's that all about? Well, you can look it up. They come at the end of an extended uptrend. Here's a bearish engulfing candle, and what you want to look for is number one, we have to finish the day there. We need to engulf yesterday's body, the fat part of that candle, as we currently have. Then I like to see follow through confirmation because sometimes you'll get a bearish engulfing in the middle of a trend. So that's step number one. Step number two, let's see if we follow through with a couple red candles. And then if so, this has been a heated pump in the market, so I would expect a pretty swift drop, and that's usually the case. Once these micro trends, that's been the case so far this year. Everybody gets excited at the top, they get bearish at the bottom, they start getting excited again, and what happens is, everybody's buying, especially retail traders, they're buying Apple and Microsoft, Intel, Facebook, all the stuff that's been going up and lifting this market lately, and then all of a sudden their stops start to get hit. So I don't know, maybe this is institutional distribution, maybe not. Maybe we're looking at a rally for the next few months. The market has yet to take out, the Qs have yet to take out these divergences right here. There's still potential divergences, but there's work to be done because this PPO is still pointing higher. These divergences are not confirmed. To keep the bearish case intact, we need to see the Qs reverse here and reverse soon. And again, right now it's looking that way. But there's still some work to be done technically. Put a little line here. We need to break below. Let's just keep it simple. We need to break below today's lows. If we do that, we take out that trend line I just showed you on the NQ. That'll most likely trigger the next wave of selling. This is a 60-minute chart of QQQ, my favorite, swing trading time frame. Of course, I have to align everything with what the daily charts are telling me. But once the daily charts confirm potential reversal, then I zoom down, look at the 60-minute chart. So what do I see? I see another divergent high. I see a pretty bearish candle so far in the works. Let's see what happens. Trend indicators are still bullish for now. There's still a lot of work to be done to firm up anything more than the case for just a little pullback. And I think even those that are bullish will recognize at least a pullback to test this uptrend line is healthy. You can't have a one-sided advance for too long. You get those lopsided advances with too many longs and all the shorts getting blown out. That's what leads to very swift, powerful sell-offs, even flash crashes, excuse me. So there it is. There's there's your first target on the Qs. I told you I'd give you guys targets. There's a trend line that you can see there. And then really what I'm looking at is a pullback to, here was a basing pattern right here we broke out of. So this purple area there, about 170.78 is the top, down to about 169.70. I'd probably favor the lower of the two, because if we start moving down, we'll probably see the momentum pick up to the downside. There's a lot of hot air in this market. So when we get a reversal, you start to see the selling accelerate, especially if that 60-minute trend line on NQ I talked about earlier goes. So, and as such, when you have that downside velocity, you'll probably overshoot the top of the support range and come into at least the bottom. So let's just say it clearly. This is my preferred target now. This would be my bare minimum target. I think this gets hit right here, that trend line. Maybe a little reaction there, but this is my preferred swing target at this time, down around we'll call it, just round it up, 170, let's just say on QQQ. So that'll be safe, a little bit above the bottom of that. And to wrap this up, I'll just rifle through the top components of the Nasdaq-100. Nothing has changed in the charts. It's been a slow grind up for Apple. We had a divergent high here, small one that was, very small, and it had a little correction, more so in time than in price. We did correct in price. There was a little pullback, but this is a correction in time. And then we pushed up, made another divergent high, which simply extended the existing divergences. PPO is pointed down now, RSI is pointed down, divergent high. You do have support here at 190.18. Then you'll have this trend line, and if that's taken out, which I think it will be, ultimately I think we come back down here to about 183.90. So for those of you bullish, these are areas that you can look to position long or add to. There's a 3% pullback. You can buy Apple 3% cheaper than you were thinking about buying it yesterday or today if you didn't do so before. Now I'm not stepping in there, but I'm just showing you levels where I expect reactions and where this pullback could end. The shallower the next pullback is, whether we get one or not right now, the shallower the pullback, the more bullish the market is, the more buyers are in the market and fewer sellers. So I'm going to give you those targets right now on Apple. I won't do this on every stock. Each of these levels. So 190.18, that's not very much. That's a minimum pullback target. Next would be this trend line, and then finally 183.90. If the bullish case is intact, we need to see at least this 179.90, 179.90ish level hold. That would be, let's just say, my current maximum swing target right now. There's certainly more priced into the charts than the daily and weekly, so I'm open to the possibility of more. But if you're looking to short this market, or you're short now and you want to try to trail down stops or get a runner trade, watch Apple along with everything else. Whether you're trading Apple or not, this is one of the top components of it is the top component of SPY and QQQ. So you're looking at as much as about almost a 7% drop, and you'd probably see the same in QQQ. All right, let's move a little faster and finish this up. Here's Amazon. I had this trend line here, just was a divergence line, nothing. It was a little price channel, I should say. Amazon is right at that trend line support. Now, this is not by coincidence, by the way. As we go through these stocks, I just showed you NQ at support in the beginning of the video. You're going to see a lot of top components of QQQ at support. So what happens is, and this is what I love about trading, when one breaks, they all break within close proximity, and then you get that pretty swift sell-off. If I was long Amazon, which I'm not, that's where I'd have a stop, right a little bit below that uptrend line. Why not? It's respected that trend line for a while now. But see these divergence highs, their divergences, that's 60-minute divergence. That plays out, in my opinion, for more than just a pullback from where we are, another 4%. It could play out for a considerable pullback, somewhere down here around 13.5% or so, potentially. Let's just see what happens. Google, GOG, divergent high. Yeah, on the RSI we had divergence. PPO's made a bearish cross. That's something I pointed out recently too, guys, that most of these leading stocks, including QQQ, made a bearish cross on the PPO on the 60-minute chart. So that's the other share class. Here's Microsoft. And Microsoft has a way to go before it tests trendline support. This one has that primary trend line. There's minor trend line we could stick in here. that it's taken out, certainly. And but again, bigger picture is this divergent high right here. We had a little divergent high here. Again, it played out for more of a correction in time than price. So there's your targets, this trend line, and then this level here. And that's a pretty significant level, 97.18. You can see a lot of reactions over the last couple months here around that 97.18 level. So, for the bullish case to be stay, very healthy and intact, you want to see this level hold 97.18. Maybe we can come a little bit below it. If not, we're probably coming back down here at about 92.56. Next one up would be Facebook, and this one looks pretty clear to me. We had a divergent high right here. We broke down below this minor trend line, this rising wedge pattern, and it's moving down. These are all different levels. I don't want to give you targets on each one because I haven't studied these charts in depth. This one, here's Intel. Intel, let's just look at it on a daily chart. You can see right here the uptrend line on the 60-minute chart, and there it is on a daily chart. This again is what formulates my longer term outlook. These 60-minute trend line breaks will they have the potential to trigger bearish technical events out on the more significant daily time frame. So here's a large rising wedge on Intel, one of the top components. This is the sixth largest component of the Nasdaq-100, and to get an idea of where this might go, this is just a measured target. You take the widest part of the wedge, which I just did, add that trend line, and this is not mere coincidence. I've done this hundreds, if not thousands of times, where I've taken pattern projections, head and shoulders, wedges, triangle patterns, take the measured target, and it lines up so perfectly with a support level or a target that I already had on the stock to begin with. So you can see 47.75 would be the measured target of that wedge. I don't think we'd go straight there. I think we'd have a little reaction here at 50.68ish, somewhere around there, and then ultimately move down there. So again, we have a bearish rising wedge confirmed with negative divergences. The measured target projects right to a well-defined support level, and and if this one happens to play out more than that, then we're probably coming back down here to $43. But right now, that would be an ideal swing target. I usually don't share trade ideas on individual stocks. Actually, this one's not an official trade right now. Was recently. We had our stop clipped for I think a like 3% loss or something minor. Kept the losses short on that one, tight on that one. But this is what I'm looking for. Next breakdown here, we might have a nice swing trading opportunity. So there it is. Let's wrap it up here. We'll see what happens. So again, let's keep an eye on those 60-minute time frames, and most importantly, keep an eye then, start to look at the daily charts and see if we do get a correction here now or next week. Remember, we have the FOMC announcement next week. So the markets, I should have said this earlier, they tend to go into a holding pattern, usually in front of an FOMC meeting. You usually don't see any big moves to the upside or downside, especially once we start next week. So that may be at least a temporary save for any breakdowns that we get right now. We could see the market consolidate, but then again, anything's possible, and that's trading. You can have what you expect, formulate your trading plan around that. That's plan A, but then have plan B. If something crazy happens, markets start moving to the upside or to the downside, you have to have plan B and plan C. And there it is. All right, guys, this has been Randy Finney with the right side of the chart. As always, if you enjoyed the video, please give it a thumbs up on YouTube. Much appreciated.